Okay, let's do some Q&A from Sunday's market outlook. It is Wednesday at about 1 p.m. It is blood red out there because of the Credit Suisse problem. I've liquidated the last of my equity REITs. I started by getting out of office REITs a couple weeks ago. Finished that up, I think, early last week. And I was slowly paring down the equity REITs, but today just made it easy to get out of all the equity REITs. Just in case you're wondering what I'm doing with the REITs. Just the equity REIT side, I think it is going to be dead money for the next couple of quarters. But I'll probably look to pick it up later in the fall. Okay, let's have a look. If you could also include commodities market overview and incorporate it into your market outlook, that would be of great help. Yeah, I guess I could put some commodity stuff in there, although each commodity is its own field of expertise. So the ags, there's a particular field of expertise with the ags, and those are really uncorrelated with the market altogether. It has its own dynamics. Same with livestock. Once you get into cattle, feeder cattle and hogs, it has its own dynamics. Metals, again, each market has its own dynamics that move it. So getting into the commodities more, each one requires an expert unto itself. So if I can find something interesting that I know enough about that I can say something, I will. But for the most part, I pretty much stay away, especially things like cotton, sugar. I really know nothing about those things. Let's see, really enjoying all the extra content analysis of the FVB situation in real time. It's been a good lesson for strategic planning, watching you prepare your portfolio for the breaking of something, and now this has happened. I'm from Canada. I'm trying to think about what could break here. I know Canadians are much more indebted than Americans, so I think that could be an area of concern, but our banking system has always been sound. It has, with a track record for some banks of over almost 200 years. I think the minimum is 150 years. Continuous dividend, never canceled their dividend, not even during the Great Depression or any of the wars, never canceled their dividend ever. They are fairly safe in that respect. Or in commercial real estate with a greater use of variable rates. I'm wondering if that could be an issue. You know what? It probably could be, which is why I decided to move out of all the equity REITs that I have. I think office will be under pressure for a while, but will come back. I think retail is going to be under pressure. And as far as apartment REITs, I don't see them hurting, but I just don't know where growth is going to come from, with most of them sitting at 98, 99% occupancy with above market rents and rents coming down. And turnover being so very low. I just don't know where growth in NOI is going to come from. So I think that it's the best of the best right now, but they have an increased cost of capital and probably a tougher debt market when they want to get debt. I think anything with commercial real estate behind it is going to have a tougher time at banks. Wider spread on any debt that they want to get. So I just don't see any upside when you're at capacity, but your cost of capital is going to increase over time. It would just made sense to get out. So I would say that the REIT space, probably in both the U.S. and Canada, the equity REIT space of almost all types, I think is in trouble. I wouldn't say office, I think, is in trouble. Retail, I think, will continue to struggle. But some of the other REITs are doing quite well. But that's the problem is this is not a scalable business. If you want to have another 100 tenants, you need another 100 apartments. You can't scale. So it's huge investments. They're chunky. And when you're running at 100% capacity, your top line revenue's in place, but your costs are increasing. That's the problem with REITs now. So I would look there. I don't know that I would look to the banks, the Canadian banks, for having trouble. I'd think that any weakness in them represents an opportunity, especially if you have a longer term view on those. Really enjoying the applied series in conjunction with the CFA curriculum. Your approach to portfolio management is interesting. I've been in the market myself for multiple years, but started managing my first external portfolio around 400K. So far, this has been working well, especially with the tools I've learned in your applied series. How scalable do you think that your portfolio management approach is? Well, I work with a lot more than 400,000. Put a zero on that and multiply it by high single digits, and you're pretty much where I would be. There's an equity portion of that portfolio that I have. Now, I don't take 100% of it and follow very tactical strategies. In markets like this, you've got to get very tactical because you've got a lot of volatility, and volatility requires you to be tactical. You can't be strategic with volatility because it doesn't hang around. It shows up, that's your opportunity, and then it disappears after a while. It just doesn't hang out. But that doesn't mean I don't have strategic allocations. I have some allocations in my portfolio I plan to hold for years. As I'm selling puts on home builders and miners as they're being put to me, I'm holding them. They're mine. I'm going to keep them. So it's not as if I do it on 100% of my portfolio. In a trending market, if we were just going straight up, I would be selling puts. Why not? I'd be selling 20 or 30 delta puts on holdings that I have. Why not make extra money? I don't think that part of the distribution is going to happen. So why have access to it? Why not sell it to somebody who wants to get rid of it themselves? I'll take on the extra part of that distribution. So it is scalable. You can't abandon a strategic allocation. By strategic, I mean your long-term holdings for whatever the next cycle you think looks like. But then you have tactical positioning from there, where you can lean into certain factors, lean out of certain factors, and have other strategies like generating income. In a trending up market, I wouldn't be selling calls, I'd be selling puts, right? Interested in Sunday night live videos. Yeah, I'm thinking about getting that done, but right now it's a rush to get the 2024 content done because each year, I think it's mid-May, CFAI announces that the next season is open, and that's when we can start listing our 2024 content. So it's a race to get that up before that date. So it's maybe in the next week or two isn't the best time, but I am looking at getting a Sunday night, probably 6 p.m., just timing with the opening of Globex, and then answering questions for maybe an hour or something. Let's see, I'm very surprised you changed your positioning with reducing your duration and getting less short on beta. I understand a reversal of those big moves may happen, and I was unsure exactly my own beta position due to the potential rebound, but selling the TLT calls to me seems like betting against your own trade right when it's working. You could say that. I had the feeling going into Friday that something had to be done. There's no way that they were going to say nothing and only show up Monday morning and say something. Something had to be done, because there was going to be a contagion effect, most definitely. And I felt that was enough, that they were going to come out and really overdo it, and it would be enough to settle it down. And going to bed Sunday night, I was right. Futures were up 65 points on the S&P, and I thought, okay, it's going to be a good Monday. I'll harvest some of these gains on Monday. When I woke up Monday morning, it was all gone. Futures were pretty much flat, and I thought, well, that sucked. And then it came back Tuesday. Tuesday gave me an opportunity to move in and out of things, and it also gave me an opportunity to sell 102 puts on TLT. So not only do I have the 115 calls, I have the 102 puts. So no matter which way it goes, I'm gonna make something on either one of the options. I'm looking to get out of the 102 puts today at some point. I just don't know when. I'm just not feeling it yet. I think, or are we 1 o'clock now? I think we're going to bleed deep red into the close. I can't see this turning around. I don't know who's going to turn this around. This is a Credit Suisse thing today, and if Credit Suisse is in trouble, that brings into question who else is in trouble, right? Until we get past this, I don't know that there's much to do. I still have my short beta position. That's working quite well. I'm going to keep that in place, but I did close half of my ZQ, only to see it move 100 basis points, the next day, and it was like, I can't believe this. So I took that opportunity to close it as well. And Tuesday I felt that I was right, but today it's like, oh, come on. When volatility is this high, it's very hard to predict what is going to happen next. So in high volatility environments, you have to be very tactical until you have clarity. We're not going to have clarity until the Fed decides. If the Fed is on hold, things are going to settle down very quickly. But if the Fed moves 25, I don't know. So yes, I will say that there are times where my tactical positioning is absolutely right. There are times where it's wrong. But I find that I'm more right than wrong. So I stick with a style that suits me best, that I feel comfortable with. So there we go. Spot on 20 minutes after Globex opening. News is out. Silicon Valley Bank deposited have access to all funds on Monday. Yeah, I didn't think that they could go through Sunday night without saying something, because as soon as the futures opened, if they were silent all night long, the damage that could have been done in the Asian market and the European market would have been big. You had to get in front of it very quickly, even before Japan opened, because you don't know where depositors are and what they'll start doing online in terms of lining up transfers out of any banks, right? My question has to do with margin available on my IB account. I keep getting the highlights in yellow with regard to my current available funds. That means I think you're under the 5% available funds. It's sort of a nice warning to say, hey, do something here. On some of my short naked puts, I bought a corresponding put at lower strike, and I did alleviate the problem, which is getting liquidity warning email from IB. But I seem to continue to get into trouble where this is concerned. Is there a ratio or a metric? Let me just move this here. That I can use to monitor on my IB account to prevent me from getting into this kind of trouble. Well, if you play at the limit of your margin, this will happen all the time. So when you have short puts in your portfolio, what you can do to when you're starting to do that, when you say, well, I'm going to sell some puts, is use theta as your metric to measure. Take your portfolio value, the market value of your portfolio, and multiply it by 0.01, 1%. Actually, 1% is aggressive. Multiply by 0.0, let's say 1. And that should be your maximum theta. So in your portfolio stats, when you look under theta, the very high level, whatever value this is should only be 0.001 of the market value of your portfolio. That will set a limit to your put selling. And you may have a rebalancing at 0.0015 or 0.002. So you just watch theta when it gets to, and you watch the market value. You're always aware of what you're going to multiply it by. And when theta gets to that level, it's time to rebalance somewhere. It's time to lower theta to some degree. And if you keep your eye on theta, I find that that's the best way to keep yourself well within the margin requirements, because as theta gets larger, sure, you have more daily income you can make from the carry, but you take on more gamma and delta risk when that happens. So that sort of indicates to you that it's time to do something. And you just try to stay away from that 5%. The nice thing about the 5% is it gives you a warning. Historically, going way back, they never used to give you that warning at all. You would just have to watch it yourself. Engineer planning on applying for some junior equity analyst roles in the next few months. Completed level 1, currently doing level 2. I don't have any prior experience working in the finance industry and have only just started looking at your applied series. My friend has recommended I do some financial modeling courses, breaking into Wall Street, to prepare for the interview process. He suggested that many investment analyst roles will ask you to do a modeling test at some point. So wondering, do you think this would be worthwhile, or should I focus on level 2? If you're at level 2, I've already answered this. If you're at level 2, the last reading in FRA, about 100 pages long, is a financial modeling reading. And through CFAI, the learning ecosystem, you can download the spreadsheets, because the examples throughout that reading all have spreadsheet examples with the example that they work through already done in the spreadsheet. So you actually get to work through it. So you already have it. You already have that that reading, that I don't know that I go paying for something else at this point, unless you get through that reading and you go, it's still not enough, I'm still hungry. Then yeah, go ahead and order more. Let's see. Questions. Given that everything happening with SVB and the response from the government Fed, why would the investor have the incentive to hedge their portfolio? Let's say hypothetically a genius analyst spent months researching the banking sector and was able to exactly pinpoint the collapse of SVB, and he accordingly shorted banks in the market. Lo and behold, this all lasts 1.5 days as the rescue immediately jumps in. The analyst is right but loses bucks. Yeah, that is the problem with the short side. You know, it's easier to short a construction firm. No one's going to step in to save that firm. But when you start shorting the banking sector, if you are right, the other side is going to load up with the Fed, FDIC, the Treasury, and suddenly they're all going to come and fight your position. If you were around in the great financial crisis, what they did on a Thursday night before options expiration is they banned all short sales of financial stocks, and I had sold calls on a bunch of financials, and I lost. The very next day I was underwater and there was no getting out. That was just it. I had sold 125 calls on Goldman, and it popped to 145 the next day. I had 1 day left, and it would have all been mine, and lost. So yeah, when you're messing around with the systemically important sector, and you're shorting that sector, and it looks like you're right and everything's about to come crashing down, and your big payday is right when they're going to come in and fix everything as best they can. And yeah, that is an issue on that one. Do you think that as an analyst, it doesn't actually make much sense to spend time and energy in researching or hedging against a crisis or deep recession? No, I think it's still worth doing. My short beta position has been working out. It's just you cannot put your position on the day it happens, because a lot of the damage has already been done. Like you had to have foreseen it. So when it comes to the banking sector, I don't understand bank financial statements. There's a lot of stuff on there I read. I go, okay, I don't quite understand what you're doing here, and I don't feel like understanding it. There are easier fights to win. I think you have to come from the banking sector to really understand banking, to look at the numbers and say, I know what's going on behind the scenes, and these numbers tell me that this is happening and that's not good. I wouldn't know that unless I were in that room at some point in time. So as far as the banking sector goes, the easiest trade, without having to pick winners and losers, the easiest trade was short duration. Fed's raising rates. It's going to break something, probably in the financial sector at some point, but I don't know where, I don't know when. But short duration is just obvious until rates get to a point where you think, okay, something will break soon, so I may as well be long duration at this point, because I don't know when, I don't know where, but if something breaks, long duration is going to pay off, right? So you don't have to pick winners or losers here. Let's see. Do you think the analyst makes much sense to spend much time and energy researching or hedging when the government and Fed simply play the role of the hedge for you? Well, they play the role of the put. Do we live in an economy when crises do not happen anymore since everything is so well connected? Well, no, we're in crisis now. I'm debating whether it's right or wrong, because ultimately people in society should be protected. I'm just seeing this from an analyst point of view. Well, you can take a long-only point of view on this, and most long-only investors look at it this way. When the economy is tanking, you have vested interests that are that come to the fore that are very motivated to fix that. The government steps in, it spends money. The Fed steps in, so you have some big players that step up and help out when things go bad. And markets spend about 70% of their time going up, 30% of their time going down. So that if you sit on your hands for that 30% of the time, the market tends to go up in the long term. That, if you look at, well, where was the market 20 years ago versus today? Even though we're selling off today, 20 years ago, you'd still be okay. Especially if you take a total return perspective, which means the reinvestment of those dividends as they come in, you get a lot more than just the price return because you're reinvesting, roughly 2% of whatever the return is per year, again and again. Here's a lot. MBS sector. If we think rates will drop at the end of this year or through the following year, will the sector face contraction risk? If yes, what's the solution? Time tranching? For MBS, if you're thinking about buying MBS and rates are dropping, yes, you will face contraction risk, but you'll have a significant capital gain on the MBS. Just you'll have to reinvest in a lower yield environment. If you're looking at REITs, mortgage REITs, as rates are dropping, their MBS is increasing. Now, they hedge out as much as they can, but it's never perfect. And they do have active hedges, so I think that probably tend to under-hedge slightly. Not much, but slightly. And they would probably increase their leverage in a low interest rate environment. So they'd probably end up doing quite well. About Fed speeches, where can I find these speeches? Typically on each of the Federal Reserve's website, they'll be available. Not always. It depends on where they are, who they're talking to. Sometimes they're live streamed on YouTube, so you can look for that. But each Federal Reserve bank, you'd have to go to each one and look for the speeches there. About Refinitive's weekly earnings report, there's a chart in those slides that shows a chart of share-weighted earnings. How do they calculate that? In the S&P, you take a stock and it might be 0.76% of the index. So you weight each of the company's earnings per share by its share-weighted component in the index. And that's how you would do that. Lots of work to do that. I don't know that that you really need to get that done. Use the S&P global spreadsheet. You have good people already doing it for you. That if you said, well, I got to get this done, it's a lot of work, maybe I'll just hire somebody to get it done. Well, why hire somebody when somebody's doing it for free? So use the S&P global spreadsheet. About CPI, on the website of the Federal Reserve Bank of Atlanta is the sticky price CPI section. There's a paper that you can access. In that paper on the 4th page, they claim that the most accurate way of forecasting the inflation is with the sticky price data. What do you think? Yeah, I think they're right. Because that's the underlying trend. And whenever you're trying to forecast, even when you're using quantitative methods, when you're trying to forecast, you're going to forecast along the trend. You're going to forecast along whatever the moving average happens to be and eliminate the random components. So the sticky components have what's called serial correlation. That means that they have some correlation with the previous observation that they had. That's what makes them sticky. Whereas the flexible components have a far more random component. So yeah, if you are forecasting, and this is true of any time series that you're forecasting, is you want to try to find the trend, the underlying trend within the movement of the data, and the rest being random. You would, basically, what's a good expression? Give it a weight of 0 in your forecasting, and you'd forecast along the trend, knowing that you'll have random movements around the trend. Last week you said you have to hide your success from other people. Don't you think that it's a bit like communism? Well, no. Communism is, the state ownership of the factors of production. I don't think that it's like communism. It's more of a, right now it's, I would call it more of a social tone that there seems to be. And I think a lot of it has to do with the polarization of media. Is that you get your news either from the left leaning channels or the right leaning channels. There's so few in the middle that certain things get echoed back to you. You tend to listen to the channels that tell you the things you already believe. It's like, I believe the other side is evil, and this channel is telling me the other side is evil. Aha, I'm right. So there's this backlash against excessive wealth. It's not a, they I think would be, a more centrist approach would be to say, is this a backlash against success? Because the markers of success are those things. Is nice cars, nice clothes, nice vacations. Those are the outward markers of success. Unless you're a lottery winner, I think. And here's the real problem I have with looking at outward markers of success from successful people and hating them, but looking at lottery winners and saying, good for you. I wish I could win the lottery too. The people who are successful probably invested capital, created jobs, built businesses, added value to society, became a taxpayer. People who win a lottery do so off the backs of poor people. A lottery is really a regressive tax. The only people, really, the majority of people who buy lottery tickets really should not be buying lottery tickets. They can't afford it. That money would be better spent on something else. And the governments control lotteries. You can't start your own lottery. That's a government monopoly. And they know it's a regressive tax. The winner who wins pays no tax. At least in Canada, there's no tax on any winning. So they create nothing for society. They get this money. They give nothing back to society. They make their money on the backs of poor people and create nothing, absolutely nothing. I mean, if we hate wealth, you have to absolutely hate lottery winners, because they're the worst, because they don't even pay tax. And they didn't create anything. They didn't hire anybody. They created no value. So in the U.S., I believe some of these lotteries are taxable, but that tax money came from poor people. And the lottery winner still created no value in creating any of that. I think that this will pass like it always has. There was a time when you could look at successful people as role models. But somehow today, success is seen as you're just part of the problem, that you're the enemy, and things should be taken away from you. So I just don't know that if I had a $1 million Lamborghini and I drove it downtown and parked it and then came back to it, it wouldn't be keyed. Like I just don't know that it wouldn't be keyed by somebody who felt that the owner of that vehicle deserved it to be driving around in something like that. They deserved that. There's that mentality that's out there. But I don't actually. I mean, I don't hide it, but I don't flaunt it. Like if you saw me walking down the street, you probably wouldn't say, and you wouldn't notice anything. You mentioned previously that you could calculate the price equilibrium of ES, not of ES, of SPX. ES is a futures, using the PE ratio of 16.6. 16.6, if you're going to use an equilibrium return, and I've mentioned this before, if you're going to use an equilibrium return like CAPM, which is an equilibrium model, and it'll give you an equilibrium return, and return on equity is usually about 11%. If you're going to use an equilibrium return, you must use an equilibrium multiple, which is about 16.6 times the forward EPS. So you have to start from, you can't just take a return and say, oh, the index is at 4,000, it earns 11%, doesn't that get you to 44.40? Yeah, but what if the equilibrium price is 3,600? I mean, here's equilibrium, and prices can do all sorts of things. So if you're saying, well, 11% from here, you're invoking an equilibrium return for a price that's out of equilibrium. Can't do that. You have to price it on the equilibrium trend. So 16.6 times whatever forward earnings you're going to get a price today. Right? That's your price today. And if you think it's got an 11% return, this 11%, by the way, if you think about it as a Gordon growth model, is a dividend yield plus a growth component. So 11% equaling that. You got to take the dividend yield out of 11%, which is about 1.8%, which means you should grow at about 9.2%. So 16.6 times your forward earnings gives you your price today. You multiply that by 1 plus 0.092. And we got, call it 10 months left. The 0.092 is multiplied by 10 over 12, then added to 1, and then you multiply whatever price you have today, and that should give you a December target price, a year-end target price. Again, that is assuming you're coming up with an equilibrium price. You could predict that the market will be out of equilibrium. You could predict that, no, we won't be at equilibrium. We'll be trading below equilibrium, or we'll be trading above. You can predict that component of it, depending on if you want to deviate from an equilibrium perspective. Are there similar methods calculating equilibrium price for CL and GC? No, there isn't, because there is no expected return on oil. Only because oil is a function of its supply and demand, whereas the price of equities really is a function of the economy, the strength or the health of the economy, and economies tend to grow over time, but oil and gold really are more of a function of other things. So there is really, I don't know that there is an equilibrium pricing on that. I think you can come up with ranges, especially for gold. You can come up with ranges. I think something below 1450 becomes a problem for gold, because gold mines just say it costs us more than 1450 an ounce to get it out of the ground, so leave it in the ground. So you shut off a lot of supply below 1450. As far as the upside, I don't know. I don't know. There is nothing for those sorts of things. Finally, given a Fed rate, how can we calculate equilibrium price for range for bond-based entities such as ZB? You can't. ZB is a futures contract which has an underlying bond. And there is no equilibrium price for the bond. It is priced on whatever the par curve is in the forward curve. So it really is a matter of forecasting where you think rates are going and what the shape of the curve is going to look like, but there is no equilibrium on that. Okay. You mentioned that paper trading on Interactive Brokers is a good way to practice CFA concepts. Yes, it is. How would you suggest practicing using derivatives on a paper trading platform? In about a week or so, or maybe even this week, I'm going to make an announcement about what I'm doing with the Applied series in August. Being that you're asking the question, I may as well just say I'm going to be doing a weekly series in conjunction. The reason I'm waiting for August is because Level 2 for 2024 opens in August. So Level 1 and Level 3 open in May, and Level 2 opens in August for 2024. So I'm going to start in August, and it's going to be we're going to manage a portfolio, a paper portfolio of $1 million from the very beginning. What is the first thing we're going to do? And every week we're going to improve it a little bit, every week. So the first week we're going to set up our screens. Well, what do we need to watch? What are the key things? What screens should we have available? Well, we better have a screen for rates. We better have a screen for market indexes. We better have a screen for critical commodities. We better have a screen for critical currencies. all of the information we need from prices. What prices are important for us to pay attention to? Let's get that on our screen. Let's build our screen. And then we'll take a 60-40 position, which is 60 equities, 40 bonds. So the question will be, well, where on the yield curve do we want to be? And for equities, it's what factors do we want exposure to begin with, and we'll start at the ETF level. And then every week we'll just let it go. We're not going to try to do any capital market expectations or forecasts. We'll just let it go. We're not too concerned about winning or losing at this point. And every week we will tweak it just a little bit. Say, okay, how can we get better? Now that we have more information, how can we get better? How can we do this? And we'll pay attention to our return over that period of time. We'll pay attention to the volatility that we took on, and every week we'll try to get better. Every week. And this will go on for the course of a year. Whenever I think about a week, I always draw a circle. Monday all the way through to Monday, and August all the way through to the next August. You may wonder, what's he doing with drawing circles? If you ever see me talking about time, I don't draw a straight line. I just draw circles because I think we're coming back around to the same point during the week or the same point during the year. What this is meant to do is, if you're a level 1 candidate or a level 2 candidate, even level 3, but more so for level 1, is it's meant to develop your skill over the course of time, but it also gives you a model portfolio that you've managed, seriously managed, that when you walk into a room for an interview, you can present the progression of your portfolio quarterly. You can present them with the returns that you've done. You can present them with the Sharpe ratios you have, or whatever portfolio metrics you have available. But you have something that you have seriously undertaken that adds to your portfolio of your job applicant portfolio. You have your resume, you have other things that you've done, you have your model portfolio that you've built to show that you can manage a portfolio of assets and achieve a particular return or achieve a particular risk profile. But it is a serious undertaking. This is not a gambling thing that we're going to do for a year. It is a serious undertaking, so that it becomes part of what you provide to the employer, saying, here's my printout from Interactive Brokers, here's my quarterly reports, or for whatever platform you're using to do your paper trading, you'll be able to produce your reports and show them how you've managed, show them what you've won on, what you've lost on, how you've managed your losses when there was a loss. If you're for this question here, a good way to practice CFA concepts, this will be it right here. It will be, I think, super important for level 1, because when you're sitting applying for a job, there's a lot of level 1 candidates out there. There's a lot of level 2 candidates who have level 1 behind them. So if you say, well, I've passed my level 1, it must count for something. There's a lot of people who pass their level 1. There are fewer people who've passed their level 2, and there are even fewer who've passed level 3. So when you walk in as a level 1 candidate, showing that you've showing your progression over time as you've learned is demonstration that you've learned. Not only that, by being connected to the world and seeing how things trade in the world and how they work, the content will be much more meaningful and easier to understand as you go from level 1 to level 2, which is a valuation level. You'll get even better. And then level 3 is a portfolio management level. You'll already have that down. When you get there, you'll say, I already know a lot of this stuff. I already know this stuff. So that's why I think for level 1, it's going to be really exciting. So it's kind of like a practical sort of add-on that goes along with your level 1. This is if we have available on the site a level 1, 2, and 3 plus option. The plus option has the applied series. You must have this option to be able to access this for August. Now, I have been asked this question, well, if I buy level 1 as the plus series, the applied series is in there, does it expire? No. Think of level 1 plus as actually having 2 components. There's level 1, there's the applied series. Level 1 expires when you write your exam, and then you move to level 2. The applied series will last through level 1, last through level 2, will last through level 3. It'll last each It doesn't expire. So the one component doesn't expire. As you move through the levels, you will always have the applied series. So I sort of just ruined my whole launch that I was going to do, but not everybody watches the Q&A, so maybe there's still some some marketing value in the launch. Let's see. In the last 3 days, the market has gone from anticipating a 50-point hike in the next Fed meeting, plus a 6-ish terminal rate, to start discounting rate cuts as early as this summer. Yes, they have. All that without any change whatsoever in what has been the actual underlying force driving rates policy, inflation. So my question is the market massively overreacting? This is the big question right now. And I want you to imagine that you are the chairman of the Fed right now, and you have a decision to make of what you're going to do. Now you can't just run to your they should stop. And it's not what you want them to do. You have to imagine that this is your job now, and history is watching you, and history will remember you. And 30 years from now, people will be speaking your name, and you really do have to think about that. What are you going to do? You on the one hand, you're in the middle of a fight, and the fight's not over. You haven't won the fight that you started. Do you simply just stop and say, okay, well, look, these other things happened? That's admitting that you broke them. That's admitting that your policy broke them, that you raised rates, and it didn't work. But it did have an effect. It broke things like you said would happen. There'll be some pain. We got the pain, but you didn't win. You lost this fight. This is Vietnam all over again. We went in and then we pulled everyone out. We didn't even win, right? What do? Do you recognize that the economy today is not the economy of the 1990s? The economy today is far less interest rate sensitive. You'll recall last year I was saying, if you're raising interest rates, where do you expect to have the effect when you have supply shortages? You first have to destroy the lineup. Look at the home builders. They were doing quite well all week. Only today, even today, this morning, they were all up in green. And it was a little disappointing for me because I look to these sell-offs to give me an opportunity to get more. And only, I think, in the last hour or so have they turned red. But I'm really hoping for a good sell-off in the home builders. But Lennar had earnings and knocked it out of the park again. And if you looked at mortgage applications this morning, they were up 6.5%. Because the consumer, if you give consumer money, they're going to spend it. They're going to spend it. So you're raising interest rates. What are you hoping to hurt? You're going to hurt housing. You're going to hurt autos. But as we already knew, they were already operating at recessionary levels. All you could do was break the banking sector. That's all you could do. Because consumers spend every penny they make. Most of them will spend every penny they make. And they don't manage the price of big ticket items. They manage the monthly payment. So they just stretch it out over a longer period. I won't get a 5-year car loan. I'll get a 7-year car loan. I'll buy a house that's 500 square feet less and I won't get a finished basement. And I'll wait 5 years and I'll get a HELOC and I'll then finish my basement. They manage that. The only way that you can get to where you want to go to now is if the fiscal helps you out. Because most of these problems can be solved with fiscal policy. Do you see that happening? You would have to come to the conclusion that, dear God, I'm all alone here. I can't count on Capitol Hill. I can't count on Washington. I can't count on fiscal policy. Increased immigration would be a huge help for me right now. That's not going to happen. The reduction of all of these spending bills, if they just didn't spend that last 1.9 trillion, that really would have been great help to me. Well, that's not going to help right now. This stupid argument about the debt ceiling, can they just get past that? Well, you really come to the conclusion that you're all alone and you have a tool, the interest rate, that just is not as effective as it was 30 years ago, and you have that nagging suspicion, but you can't admit it publicly, but you kind of know it, but history's watching you. You're in the spotlight. What are you going to do? What do you do? This is the job this guy has, and you kind of got to feel sorry for the guy saying, you're getting no help from anybody else. You're in this fight all alone, and you're losing, and you're losing. And no matter what you do next week, you're going to lose. You raise rates, you're going to lose. You don't raise rates, you're going to lose. You cut rates, you're going to lose. I don't know. What would you do? Seriously, think it through. What would you do? I haven't got a clue. It's going to be, I think, one of the most interesting Fed meetings to watch. We also get the dot plot. You also get updated summary of economic projections, and you get the showstopper, the press conference, of which we all know Powell is just absolutely great in press conferences. So, do we expect Powell to drop his fight against inflation in order to help the banks? The market seems to think he has no choice at this point, that he has no choice. I kind of think the same thing. I kind of think you're going to get a hold where he's going to come out and say, we're on hold because of this. But if you think we're done with this fight, think again, buddy boy. But we're on hold because of this, and we'll get through this, but we're going to get back to business here shortly. I think that's about his best chance. How would you calculate fair market value of this? Oh, I already went through that. CPI report, trying to pull services apart and remove shelter. For CPI, shelter's big. So what you have to do is you have to take CPI, which I think has got a weighting of 58%. Shelter's got 32% of that. Then you just have to pretend that the rest of it represents 100%. And recalculate what that would be based on that being just that. In other words, that's your universe. Shelter minus CPI minus shelter. And then you have to reweight them all based on, well, okay, if there's 26% left, then 100 divided by 26 is 4 point something. You multiply each one by 4 something, and then you weight them. You just have to reweight the 26% left as if it were 100%. That's all. What else do we got? Let's see. Let me finish this. To my eye, it sure looks like services are largely unchanged, but is this services significantly different to what's measured in PCE? Yes. In PCE, shelter is much lower. Health services costs are much higher. So yeah, it is. The PCE is the one that's paid more attention to. Let's see. Peso exposure. Are you simply looking at the currency? Right now, that's all I'm looking at is the currency. And I did take a position on the peso. Yesterday, I did 19, covered at 18.75 because I just didn't feel it. Went back to 19, did it again, covered at 18.70 because I wasn't feeling it. Today, got it at 19.03 again. We'll see what happens, but I'm probably going to add about every 0.3 up, so 1933 I'll add, 1963 I'll add. That's my trade plan on the way in. We'll see what happens. But no, I haven't been buying any particular companies or anything in Mexico just yet. At some point I might be interested in their market, but right now it's the currency that has really impressed me. I don't see it going away just yet. Make a daily this week. This is nuts. FRC down 80% right now, even after all the announcements yesterday. Yeah, that's just going to have to work its way through the system. How do you go about assessing your portfolio's performance? If the value of the portfolio is higher each day, it doesn't always work that way, but I do try to make sure. Like on a week over week basis, I look and I should be the same or higher. At least not that I would do anything crazy on Friday just to make my numbers, but I don't like portfolio values that do this. I don't like that kind of stuff. I prefer to have it do this kind of thing. And you can do that. It's just you have to manage your risk levels a lot. Now, I don't do that all the time. It's just in a period like this where volatility is what it is, you have to be much more tactical. So you do have to try to get as neutral on your exposures as you can. That doesn't mean you make nothing. It just means that you make it steady but slowly. Once I feel that this is beyond us and past us, once I see that unemployment has gotten to 4.3, 4.4%, and the Fed is, on its rate lowering process, I will not protect the downside anymore. I will pull all of my short calls on the upside, because then I can do this kind of thing. This is where you really want to be on this, and I do think we have that in our future. It's just how many quarters do we have to get through first before we get there. But if you have the applied series, you don't have to have the, like I explained earlier, the level 1, 2, and 3 plus series. The applied series in there. I will be doing that portfolio thing starting August. That's for all the just straight applied series subscribers as well. So during that period of time, each quarter we will be doing, okay, let's look at how we did. Let's generate our numbers. Let's generate our report. Let's look at our volatility over that period of time. Let's look at our return. Let's look at our ratios. What was our maximum drawdown during that period of time? Everything you would do to report your performance. In the aftermath of the SVB debacle, I'm confused about the U.S. dropping, whereas TNT and gold are raising. Well, when you wrote this comment, if you would have waited 10 minutes, you probably would have wrote another comment. And then if you waited 10 minutes more, you would have wrote a different comment. So US is up today. Gold is up. TLT are up as well. Obviously, there's an understandable flight to safety going on, which usually favors USD. How come not this time? I think the TLT was going up because the belief was that rates are going to go down. Rates going down, that means, if rates are going up and that's supportive of the dollar, rates going down is less supportive of the dollar. So that is consistent on its own. Rates going down is an issue for inflation when inflation's still around. So gold will say, hey, if interest rates aren't going to do the job, I will. I'm here. But gold doesn't do well when interest rates step up and say, I'll take care of this, thank you. It's when interest rates don't say, I got this, that gold says, I'll take care of you. I have TED spread on my watch list. I remember from CFA level 1 fixed income that TED is a good measure to watch for any weakness in the banking industry. Yeah, because it's the interbank rate, the spread between interbank rates versus the treasury rates, and you would have to look at the euro dollar for that. Is that a correct measure? Yep. I'm curious as to why the yen is still considered a safe currency. Well, we have to get out of North America to understand the world, right? There are 3 big regions in the world. There's the Asian, the European, and the North American, South American. And in each of those regions, there's a safe haven currency, the yen for the Asian market, the Swiss franc for the European market, and the US dollar for the North American, which is also more global as well. So in times of crisis, money rushes into very large currencies. You need a very large currency to get this done, and a very safe currency, a place where you can hide. So the Swiss franc, the Swiss franc, I think, because of its neutrality, the Swiss franc, the yen, and the U.S. have always been the beneficiaries of fear. Only because you need a safe place to hide. You're not even caring about return at that point. You're just caring about preservation of your dollars. And you just need a safe place to hide. They're seen as just safe places to hide. Just to echo back on your oil and gas trade, a quick look at 12-month average miles driven on foot. Well, I don't know that I would look at the past to determine what's going to happen going forward. Oil is down 6% today. Gasoline is down 5.1%. So long gasoline, short oil, still paying off because your short position's down 6%, but your long position's only down 5.1. You're still making that spread, right? When I asked a few weeks ago what you thought of BDCs, you said you weren't familiar with them. Probably because it didn't register in my brain. You know how many acronyms there are in finance? Everything's a bloody acronym. So, when your mind is focused on something, you'll see an acronym and you think, well, is that a digital currency from a central bank? I thought that's what I thought that's what it was referring to. It just, the longer you're in this game, the more acronyms you're going to come across, and the more some of them will all sound like some other acronym somewhere else. This industry loves acronyms. So probably just a brain slip. Met up with an old friend who is a huge admirer of Warren Buffett. You met up with an old friend and you talked business? You didn't say, so tell me what you're doing. What are you up to? You're looking good. What's going on in your life? Unless he's not looking good, then you can poke him in the stomach and go, hey, like the Pillsbury Doughboy. Okay, so you talked Warren Buffett. His investment philosophy is entirely based on value investing, which means he tries to identify undervalued companies based on an estimate of intrinsic value in combination with the company's future competitive position in the industry. Yeah, that's a good summation. Claims he can outperform the market with this strategy, although he does not use a benchmark. No, not really. Why use a benchmark? A good benchmark is a cash rate plus 400 basis points. That's a good benchmark. We had some conflicting views because he said he does not believe in taking short positions. There are some people who don't believe in that. That's fine. The gain is limited and the potential loss is unlimited. Well, short positions, I don't look at short positions as having that profile. It's think about correlation. 0 plus 1, negative 1. This is maximum diversification, right? This is replication. If you're trying to replicate something, find something that has a correlation of 1, and this is a perfect hedge, is a negative 1, right? So if you have a portfolio of stocks, A, B, and all the way to X, and you're expecting market weakness, you could just say, well, I could lower my beta exposure. Let me sell 20% of my stocks because I'm expecting a bear market over the next little while. Well, why sell 20% of your stocks when you know how to create a perfect hedge, which is a short position on the market? A short position is the same as selling 20% of your stock to lower your exposure. It does not have to be a bet on a direction. It just can be used as a hedge. I predominantly use shorts as a hedge or as a method of income production. So he may have a very limited view of what taking a short position means. Does not believe in using options and other derivatives to manage a portfolio. He calls them financial weapons of mass destruction. Well, they're financial weapons of mass destruction if you're using them to speculate. But they cannot be weapons of mass destruction if you're using them to hedge. By the very definition of the word hedge, they cannot be. So let's say that you had an equity portfolio which has a beta, let's say, of about 1.1. And you feel, based on where we are now in the market, you think, you know what, the market's going to suck for the next 6 months. I should sell everything and go to cash. Let's sell everything and go to cash. Well, the futures price is based on the spot price carried by the differential between the interest rate and the dividend for a period of time. That is called the carry. And you have a curve that looks like this. So if you short, you have positive carry. So what you can do is you can short the index in enough contracts that bring your beta down to 0. And what are you going to get? You're going to get a cash rate without moving the cash. This is a way to take a portfolio of stocks and turn it into a cash portfolio by hedging out the market risk of the portfolio. Now you don't have to sell all your stocks and move to cash and buy a cash-bearing certificate. You're going to get a cash return because it is priced into the futures contract. You're short, you're going to get the positive carry out of that. So they are useful in a hedging capacity. Where they are weapons of mass destruction, as Warren Buffett calls them, is when you use them to speculate. Then yes, they can, and especially in crowded trades, highly correlated trades, they can be weapons of mass destruction. But when you're using it to hedge an existing exposure, how can it be a weapon of destruction? it's a weapon of preservation, if anything, right? My gun is not an assault weapon, it's a defense weapon. I use it for defense, however you want to look at it. Only invest in stocks because he says that other asset classes underperform in the long term. You have to sort of understand the difference between mean reverting performance and non-mean reverting. Equity prices usually, as a group trend upwards, even though the returns are mean reverting. There are periods of times where equities underperform. And real estate can outperform. Well, private real estate, private credit, they can outperform during periods of time. So I don't know that is true over long periods of time. I think it's a great rationale for why you do what you do. And if it makes you good, makes you feel good, then great. Everybody has a skill set and a place where they feel the most comfortable. You like playing first base, you're the best at first base, fine. I'm not going to send you to third base or home plate or shortstop. You're a first base player. You've developed the skill to play first base. You can always point out, but there are outfielders, there's third base, second base, home plate, pitcher, shortstop. There's all these other positions. Why are you limiting yourself to first base? And well, it's because that's what I learned. I learned how to play first base. I'm really good at first base, and this is what I'll play. Yeah, there are many, many positions that you can play in the game, but you will eventually find that you function the best and you do the best when you pick a position and you learn that position really well. Let's see. What is your opinion on value investing in general? Yeah, I'm good with it. What do you think about the arguments mentioned above? Well, there you go. Seems rather conflicting with what we learn in the applied series in the CFA curriculum. Well, the applied series is more hedge fund style. If you're going to be a long-term investor, I guess the lesson would be simple: buy the market. Buy the market and dollar cost average over the next 20 years, and you'll do just fine. The style that I'm showing with the applied series is more hedge fund style, because if you buy the market, it won't be long before you say, I can do a little bit better than the market. The market's trending up. What if I sell a put for 10 delta? I mean, that's, for the market to turn around and hit my 10 delta would be almost nothing, but I can sell a put for 10. And you'll find that works in an uptrending market. And you'll say, well, okay, there's something better than just the market, right? And then you'll say, we're really doing well. But given the conditions we have in the market, consumer discretionary tends to really outperform the market in a recovery. So why am I buying the SPY, which is the market? Why not the next time I buy some XLY, which is the ETF for discretionary? Well, suddenly now you're leaning into a particular sector and you're saying, but I can do a little bit better than the market. And a couple of months later, you may say, but now I just noticed something else. I can pick up this at the same time, or I can do this. And over the years, you will feel that the strategies you're following are still simple, but somebody looking in will go, why are you doing all that complex stuff? You can't beat the market. You can't do this, because to them it looks extremely complex. But you, over time, developed that particular skill where you said, but I think I can do a little bit better here. Can you discuss differences between reverse repo and the new bank funding term program? Yeah, so the reverse repo, you have to post collateral. So if you want $1,000, you got to post probably 1,030 of collateral, 1,020, whatever it is, and that's based on the fair value of whatever it is you're posting. The new bank funding term program says it doesn't matter what the market value of the security you're posting is. We're going to lend you money based on its future value, based on its par value. So in a repo, if you had to borrow $1,000, let's say, well, let's put it this way. Let's say you had a bond that was selling for $835, which had a par value of $1,000. You could post this as a repo. The haircut might be, $7 or something. They might lend you $828 against your $835. Whereas if you under the new program that would count as $1,000 even though it's only worth $835. And then let's say it's a 2% haircut, you could borrow $980 against this, so that you're actually borrowing more than the collateral you're putting up. But it's cash good collateral, meaning that if the bank had to take it from you, if the central bank had to take it, they'd say, well, we can hold it. I mean, we're going to get all our money back. We won't lose. We're just not going to get it back today, but we'll get it back. So that's the big difference right there. The other difference is repo is 1 day, and you can have a term repo like 7 day or 30 days, but to do it for a year, you're basically showing up every day and posting your collateral for repo, whereas this is 1 year, straight up 1 year, right? And it's based on the face value of what you're borrowing. Update on charge point position, that's in the applied series, and I think I was in that for less than 90 days. Everything got called away from me, walked away on that position with a $4,400 gain. So turned a $4,000 loss into a $4,400 gain in a period of 60 days. But that's in the applied series. Do you think the SVB collapse could highlight any sort of possibility of a liquidity crisis if depositors leave banks? Yep. Yeah, I think it can. That one was easy, right? Can you please go over how you determine the healthy amount of DDB exposure in your overall portfolio? I don't know that I have a healthy amount, and it really depends on what it is you're trying to get done, what's going on. There's no number. There is a North Star. Let's just say that. There's a North Star, and that's 0. And if I feel good, well, then I'll move positive. If I don't know what's going on, I'll try to stick as close to the North Star as possible. If I feel bad, I'll move negative. And that's it. So I don't think of it as here are specific numbers you want to look for. I couldn't even tell you what DDB could be, because your dollars in your portfolio will be very different than the dollars I have in mine. So my DDB, if I say, well, try to target 8 million. Well, if you got 20,000, you're never going to target 8 million. But for me, that may make sense if I'm somewhat bullish, right? Let's see. So I'll just pass on the rest of that, because I think it just asks more about the same. Canadian banks should be quite well insulated from American banks and regulations. And as you stated, they skated past the financial recession in 2008. What I don't understand is how come TD and BNS are being affected proportionally more by the issues with U.S. banking sector compared to other Canadian banks such as RBC. It depends on how much U.S. exposure they have. I'm a customer of TD Bank, and I know I have money in the Philadelphia branch. So I know they have U.S. exposure. The significance of spread widening on 10-year UST and 30-year FRM, well, it just is a wider spread between the mortgage rate and the Treasury, which just makes mortgages more expensive overall relative to where the 10-year is. So you can say, well, 6.5% is more expensive than 6.2%. But if the 10-year is higher at 6.5%, then the mortgage is relatively cheaper based on where the 10-year is at 6.5. If the spread was, let's say, 140 points, but maybe at 6.3 the spread was 200 points, which makes the mortgage more expensive relative to where the 10-year Treasury is. It matters when you are isolating the difference in spread between, let's say, an MBS and a 10-year Treasury, which is what mortgage REITs do. So they don't hedge the spread, they hedge the interest rate risk, and they lever up the spread. So looking at the spread between the 10-year U.S. Treasury and the 30-year FRM gives you some idea of what's happening to the spread in MBS as well. Insider sales are part of a 10B51 plan. Yeah, so that sort of has come out that was planned a while back. It's just the optics. That you would have had to be aware that, okay, Tuesday the share sale will go through. Great, I'll sell some of my stock. Wednesday we'll announce, that we're going to take a $1.8 billion hit and we're going to float some equity. And we already know Moody's is going to give a credit downgrade. Yeah, that's all in place. it's the optics. You would have said, I should cancel this share sale just for the optics of it. Even though you had it planned way back, yeah, you should have canceled it. But, as I've said before, ethics is a very special type of behavior. Most people will be ethical if it doesn't cost them anything to be ethical. But the moment it costs them money, sometimes they'll say, the right thing to do is to cancel the share sale, but it's going to cost me money, so I'm not going to do the exact right thing. Besides, I planned it 3 months ago, so, that's okay. It's the optics, right? Could you please explain why you think the correlation between stocks and bonds revert to the pre-2008 numbers? Well, whenever there's a crisis, money rushes into treasuries and risky assets sell off. That's why. Okay, I already answered that. Won't a backstop risk having other banks take bigger risks with their assets? I don't know if that would. No, I don't. Well, I'm not going to say no or yes. I'm going to say a big I don't know. I would have to really think that one through, and I would have to think, well, let's assume I'm a bank, and then I'd have to think through all of the implications of it. Like a chess game, I'd have to play 5-6 moves ahead to figure out whether or not this is the game I want to play. So offhand, I don't know the answer to that. Where do you take the earnings? Forward earnings estimate of SPX. Look in the description box. The first link is the spreadsheet. Why would a flight to safety favor the yen over the... Okay, I already answered that. Update your position on CS stock. I don't know enough about Credit Suisse to give a position or anything on that. I think it came from a significant investor. They own just a little under 10%. Saudi, was it the Saudi bank? And they said no, they would not be willing to put any more money into Credit Suisse because they have that 10% regulatory threshold and they don't feel like taking on another regulatory layer. So they just said, we wouldn't be interested in that. And that, when your biggest investor, when somebody that owns 9.8% of you says, we're not putting any more money into this, it's, what's going on there. On TLT versus ZB versus UB, at times the three have been very tightly priced together, but have lately diverged. Well, TLT is probably hard to do any kind of arbitrage on, which usually ETFs rely on that because it does hold the underlyings. So it would be fewer market participants that probably engage in that, and in times of huge volatility, just to figure out what the intraday value is, with and that word's right there on the tip of my tongue, and my brain is saying, no, let's just hold back those words. Let's make them look foolish for a minute. We'll release those words. Net asset value. There it is. It just wanted to make me look foolish. It's hard to figure out what intraday net asset value is when yields are moving the way they have been moving. Some days, my Monday was just incredible, and today again is just incredible. That to try to figure out where intraday NAV is at any given time, I think would probably be challenging in trying to get it done. I don't know enough about it to give a definitive answer, but that would be my first guess, that it would be far more challenging to calculate intraday NAV on their underlying or on their creation basket than it would be on an equity like SPY. How does the issuance work and interactive insurance work in case of liquidity crisis? I think it's up to $1 million on brokerage accounts. I don't know. I think it might be different for each country. Let the announcement about CFA entrepreneurial paths go along with MM's applied series. I don't know what CFA's announcement is going to be, but they do have something they're going to announce. We're almost near the end here. Can you please express your opinions on whether the market betting on no further rate hikes would become a reality, or will the Fed stay strong? That's the coin toss right now. I don't know. Fed Watch tool has a weighting, almost equal weighting now, on 0 move and 25 basis points. And on the, if you go back to the market outlook, I said it wouldn't, by the end of Monday or Tuesday, that it's fairly likely there'll be a 0, that the 50 basis point move will be gone, and it'll be a fight between 0 and 25. I think as we move into the end of the week, if this blood continues in the market, I think all the weight will move to 0. How many DTE do you think is normally optimal for selling puts? For selling, I try to target 30 to 45. Depends on what's going on, what the premiums look like. Sometimes 45 to 60 makes more sense. Sometimes 30 is good enough. You look at the 30s or even the 25 to 30 days and say, well, this is pretty good. I can take this. It depends. But I certainly wouldn't be looking at selling puts, 5 months out for income. That's too far. How do you think about a price target for TLT? I don't, because it's all interest rate driven. What's the difference between put call? Already answered that under here. With the pullback in agency and annually, is there a retail trade to board, a fixed rate invest in these REITs? I wouldn't do that. I wouldn't do that at all. I would simply just, if you're interested in them, just buy them or create a synthetic to own them. Why is there a spike? I already answered that. Grave mistake to lower rates. Well, yeah. Fed's conundrum. Question is, what's the right direction? Okay, that's more of a comment. Would you buy back puts on those underlyings if the market rebounds next week? I did do some of that, yeah. Ninja Research, I put a video out on that one. That one was so obvious that it was a scam. I mean, it was just so obvious. If you go to the website and you just do some poking around, you go, okay, this is, if it's not a scam, it's a group of kids that have no idea what they're doing, and just no idea. So, but I think it's a scam. I think it's designed particularly to be a scam. And just to scare people, and that's it. It's knowing what I know about ABR. As soon as I read a few lines, I go, okay, God, this is bullshit. This is pure. Who are these people? That's when I clicked the about us. Like, okay, I'm done. I know exactly what's going on here. 2 questions regarding ethics. Behavior of SVB management seems to be the perfect case for ethics. They may have violated many ethics rules for sure. But which ones they violated the most, assuming they are all CFA charter holders? Yeah, I'm not sure that they are. I know that there are charter holders who work at the bank. I don't know about management. Yeah, I don't know. Can we count incompetence anywhere? Poor judgment. Poor judgment, I think. The new CRO, what should she have done when she first came to SVB to try to be compliant with CFA ethics? Did she violate any rules? I mean, she's a fresh one, so we cannot blame her for past negligence of interest risk. Probably not. From what I'm hearing from more reliable sources, because I mean, all we have to go on is the information that we get through our news feed, unless you can actually sit and talk with someone. But I have spoken with a far more reliable source, and it's the focus should be on the CFO, not the CRO. So it could be that I was overly critical of not having a CRO in place without leaning more heavily on, well, what was the CFO doing at that time? If the firm's pulling their money from all these banks, where is money going? Probably just a bigger, safer bank. Do you think bank term funding program is as stimulative as people are making? Stimulative? I don't know that it would be stimulative. Seems like a 5.48% interest rate on loans is prohibitive to arbitrage. I don't think it's stimulative. It is meant to eliminate a liquidity problem where you have to sell assets that are underwater to meet depositor outflows. Now you could just post that as collateral and get an advance on the face value. I don't know that banks are going to use that as a form of stimulation so that they can now make more loans and get more aggressive. I think I don't think that that's what that is at all. So no, I don't. You're going to have to explain to me when you say as people are making it out to be, who are these people that are making it out to be that? First of all, that would be my first question is, who are these people, right? Isn't a government guarantee of SB deposits no different than a bailout of these banks, as these deposits were utilized to build a business, generate spreads for income, etc.? Okay, I want you all to think about this. You just won the lottery. You won $1 million. You went to your bank, you put the money in your bank, because where else are you going to put it, right? You put the money in the bank. You're a customer of a bank. You're in no position to start evaluating a bank's financial statements to determine where you want to put your money. You put $1 million in, next day they're gone. But don't worry, you got insurance on $250,000 of it. How do you feel? Not your fault. How the hell are you supposed to know? Now, I want you to really put yourself in that position. I want you to really think about, are you okay losing the $750 as you are judging others who are getting those? So if you say, why are they bailing out all the depositors? Well, would you be okay not being bailed out? Would you then say, I don't deserve to be bailed out? I don't deserve to be bailed. I got my $250. Sure, I won $1 million, life-changing sum of money. $750's gone overnight, but I still got $250. I'm good with that. I'm going to go along with that. I agree with everyone else. I should not be bailed out. Really put yourself in that position. It's not your fault. You're just a depositor. All you did was you put your money into a bank account. That's all you did. You placed trust in the system. You're not a bondholder. You're not a shareholder. You don't own any preferred shares. You're not a CEO, a manager. You're not part of the bank in any way whatsoever. You just put your money in the bank. That's all you did. Well, I think that you can agree that no, you had nothing to do with this in any way whatsoever. That bank was supposed to take care of your money in a very particular way by keeping it in securities that had a low amount of duration, especially in environments where rates were going up. But it's not your fault. In the least, it's not your fault. Why should you pay? Now, once you recognize that that's the right thing for you, you must agree it's the right thing for everyone. You cannot have a set of rules that apply to you and a different set of rules for other people. What I find today is that you have a bunch of people out there that are super, super generous with other people's money, but not their own. Super, super generous. You have to design a system, and I think it was Rawls, or I'm not sure which, somebody can fill it in the comments section here. This is sort of a justice theory called the cone of ignorance, that you must design a system under the cone of ignorance, that you don't know what your place in society will be. Now design a system. So all too often we judge what's happening with a policy based on where we are in the system. So we don't have the money these people have. And we look at depositors being bailed out. Silicon Valley, their venture capital firms, we have this idea in our mind of the lives they're living and how well they have it. And why should they be bailed out? But because you can say that because you are aware of your place. But under the cone of ignorance, if you are unaware of your place in society, and you now had to design a policy. So you don't know, I'm about to put you in society, and you don't know where you're going to end up. I'm asking you, should depositors have insurance on all of their deposit, or should they forfeit some of it because it's over a certain limit? Now, you don't know if you're going to be the one over the limit or not. What would you say? And that's the only fair way, the only just outcome is to design a policy completely ignorant of what your place in society is. But that is a growing problem today, is the amount of people who just seem to be super generous with other people's money. But if it came to their own, oh no, different set of rules for me, please. Different set of rules for me. Let's see. You know, it's kind of the saying, everyone's a Democrat till they start making money. Let's see. And that's it. That is it on the Q&A for the market outlook for this week.